Good day. Welcome to the Twin Disc Inc. Fiscal Fourth Quarter 2020 Earnings Conference Call. Today's conference is being recorded. At this time, I'd like to turn the conference over to Stan Berger. Please go ahead, sir.
Thank you, Eduardo. On behalf of the management of Twin Disc, we are extremely pleased that you have taken the time to participate in our call. And thank you for joining us to discuss the company's fiscal 2020 fourth quarter and full year financial results and business outlook. Before introducing management, I would like to remind everyone that certain statements made during this conference call, especially those that state management's intentions, hopes, beliefs, expectations, or predictions for the future, are forward-looking statements. It is important to remember that the company's actual results could differ materially from those projected in such forward-looking statements. Additional facts that could also cause actual results to differ materially relate to the global COVID-19 crisis. Information concerning factors that could cause actual results to differ materially from those in the forward-looking statements are contained in the company's annual report on Form 10-K, copies of which may be obtained by contacting either the company or the SEC. By now, you should have received a copy of the news release, which was issued this morning before the market opened. If you have not received a copy, please call Annette Mayanaki at 262-638-4000, and she will send a copy to you. Hosting the call today are John Batten, Twin Disc Chief Executive Officer, and Jeff Knutson, the company's Vice President of Finance, Chief Financial Officer, Treasurer, and Secretary. At this time, I will turn the call over to John Batten. John?
Thank you, Stan, and good morning, everyone. Thank you for taking the time to join our conference call. As you all can imagine, the fourth quarter was a challenge, but I thought our team responded very well and delivered results even above our expectations. And again, facing really in the fourth quarter the third challenge that this team's had to face, and the two headwinds that continued to push us before COVID were the global trade wars, especially with China, the Saudi-Russia oil war, which drove the price of oil down even before COVID, and then COVID on top of that, which really affected all of our markets that had remained somewhat healthy, whether it was marine or industrial, and we saw a dramatic slowdown in projects and new orders. In general, I thought our team did a fantastic job globally, getting product out the door that mattered most to our customers. Priorities were always changing, and you never knew, particularly in Europe, whether which supplier was going to be open or closed, and which customer was going to be able to take product and pay. Our facilities in Racine and Papendrecht, Netherlands, remained open throughout the quarter, throughout the COVID crisis, and even with the forced shutdowns in Italy, Belgium, and Switzerland, our team did a great job of bouncing back and getting everything out the door that could go out the door. Earlier in April, at the end of the third quarter call, we announced that we applied for and received the PPP loan, just over $8 million, and we used the vast majority of that to pay full salary, wages, and benefits here in North America, or in the U.S. Racine and our Racine-based employees. Those funds ended on July 24th, and we had to react based on the conditions that we faced and we see for the next few months. And really, the known conditions that we can see at this time, but the unknown length of the bottom. Jeff will provide more detail on those cuts. But at the end of the third quarter call, we announced $4 million in cost savings for the PPP, and yet to this morning we announced just over $7 million. Those aren't addition; that's just a ratchet up. 3 months ago, we thought $4 million would be the right number, and today we think that's just over $7 million. A lot of things, I would say, we see some signs of life. Our average daily order rate has ticked up slightly, but it's certainly not back to the level where we're going to see the backlog growing. So it was necessary to make these cuts. Jeff, with that, I'll let you go over some of the numbers before I come back on the outlook.
Sure. Okay. Thanks, John. Good morning, everyone. I'll briefly run through the fiscal 20 fourth quarter numbers. Sales of $59.4 million for the quarter. We're down $13.1 million or 18% from the prior year fourth quarter. The decline from the prior year, as John mentioned, principally driven by the ongoing effects of the COVID-19 pandemic on the global economy, significant reduction in the North American fracking market, along with a softening in the global marine and industrial markets. The oil and gas decline, in particular, accounted for approximately $8 million of the fourth quarter reduction in sales. For the full year, sales were down $55.8 million, or 18.4% compared to the prior year, with foreign currency exchange contributing $4.8 million to this decrease. The fourth quarter margin percent was 23.2 compared to 22.7 in the prior year fourth quarter. Our favorable gross margin performance for the quarter versus the prior year was the result of some targeted cost reduction efforts on key products, along with a global focus on cost reduction. The margin percent for the full year fell to 22.6% compared to 29.6% for the fiscal 19 performance on a more difficult product mix. And if you recall, we had a $6 million $6 million product performance charge that we recorded in fiscal 20. Spending on marketing, engineering, and administrative costs for the fiscal 24th quarter decreased to $1.2 million, or 7% compared to fiscal 19. The decrease is a result of a sort of broad-based focus on reducing costs, in particular reduced professional fees, salary expense, corporate travel, marketing activities, etc. With the oil and gas market struggling over the past 4 quarters now, along with the downturn associated with COVID-19, we have aggressively pursued cost reduction opportunities to compensate for the decline in gross profit. For the full year, ME&A spending was down $8.3 million, or 12%. As John just noted, and as we announced in the press release this morning, we have taken cost reduction actions that will provide $7.2 million in annualized savings, primarily at our domestic locations. And again, to be clear, this is not in addition to the $4 million in savings we discussed at our third quarter call. It is a reaction to the full utilization of the PPP funds and the current market conditions, indicating that we needed to again take an aggressive action to put our cost structure where it needs to be for the next few quarters. The current action reinstates the savings that we announced earlier with an additional $3.2 million of annualized savings. Restructuring charge of $200,000 was reported in the fourth fiscal quarter. Similar activity to what we've had throughout the year, primarily related to ongoing cost reduction and productivity actions at our European operations. With the reduced fourth quarter volume and challenging product mix, we reported an operating loss of $1.5 million in the quarter, compared to a break-even quarter in the prior fiscal year. For the full year, operating profit has declined by $58.8 million to an operating loss of $40.3 million, compared to an operating profit of $18.5 million in fiscal 19. The fiscal 20 year-to-date result includes $5.1 million of restructuring charges, the $6.1 million product performance charge I noted, and the $27.6 million impairment charge recorded in the third quarter. Adjusting for these items, the year-to-date operating loss would have been approximately $1.5 million, or a $20 million decrease from fiscal 20 on a $56 million reduction in sales. The effective tax rate for fiscal 20 was just 9.5%, significantly lower than the prior year rate of 25.6%. The current year rate was significantly impacted by the $26.7 million impairment charge recorded in the third quarter, which resulted in a 13.3% decrease to the current year effective rate. The current year rate was also impacted by the GILTI provisions of the Tax Cuts and Jobs Act, which require the inclusion of foreign income but prohibit certain foreign deductions and credits when in a domestic loss position. The GILTI inclusion decreased the year-to-date effective rate by 2.8%. The net loss for the quarter, for the fourth quarter of fiscal 20, was $1.8 million, or 13 cents per diluted share, compared to a net loss of $0.8 million, $800,000, or 6 cents per diluted share in the prior year fourth quarter. And for the full year, net loss of $39.8 million, or $3.03 per share, compared to a net profit of $10.7 million, or 83 cents per share in fiscal 19. EBITDA of $1.3 million for the quarter was down from $2.9 million in the prior year fourth quarter. For the full year, EBITDA finished at negative $30.2 million compared to $29.9 million positive EBITDA in fiscal 19. The current year EBITDA includes a $27.6 million impairment loss recorded in the third quarter. As we indicated during the third quarter call, challenging market conditions made it highly likely that we would not be in compliance with the leverage ratio covenant included in our BMO credit agreement for fourth quarter reporting. We began discussions with BMO during our fourth fiscal quarter and were able to finalize an amendment to address this issue on July 22nd. This amendment removes the leverage ratio covenant beginning with the recently completed fourth quarter of fiscal 20 through the fourth quarter of fiscal 21 in favor of a cumulative minimum EBITDA covenant. Certain projections indicate compliance with this revised covenant, but do require improving market conditions through fiscal 21. Inventory was down $7 million in the quarter and $14 million in the second half as reduction efforts remain a priority. With solid inventory improvement and good working capital results, operating cash flow was positive $4.3 million in the quarter. Capital spending was the lowest level of the year at $1.5 million for the quarter, resulting in a positive free cash flow of $2.7 million for the final quarter of the year. As we enter what we anticipate will be a challenging fiscal 21 market environment, we will be deferring all non-essential capital spending and expect to invest $7 to $9 million during fiscal 21. And with that, I'll turn it back to John for some final comments.
All right. Just a quick look at the outlook. As you can imagine, our big takeaway from Q4 is that the second half of 2020, the first part of our fiscal 21, will be very challenging in all of our markets. Orders were not strong. That's reflected in the backlog. Although I would say in July, the average daily order rate did improve, showed some sign of life, but they have a ways to go. In some other areas that we're seeing signs of life, we have active projects in oil and gas in China, some military projects in marine that are close to fruition, new applications in volume in North American industrial customers with our new products, and words from our customers in the North American oil patch, our 8500s are working strong and working every day. We continue to be impressed with our team at Batten in the Netherlands and their resiliency to drive projects through to fruition, get new projects, and do this all remotely around the world without traveling. We also continued in the fourth quarter and up to now active projects in design and getting product ready in hybrid and electrification projects with cranes, ARC vehicles, in oil and gas, and in marine. So our product development continues to push forward despite the market conditions around us. And a little bit of clarification on the press release on operation of the Lufkin facility. We took possession and occupancy on August 1st, and so we plan to be in production with our first models of PTOs probably in middle to late second quarter. And we are very optimistic that this will drive future growth in our industrial business as we have a team in Texas focused on our customers every day on this product, which has a very different cadence than the other products that are at our 21st Street facility, which are the oil and gas transmissions, ARC transmissions, and marine transmissions. Much different cadence, different suppliers, and we're very optimistic about the future of the Lufkin facility in our industrial business. The Racine facilities, we're looking, with work from home and a reduction in headcount, we are looking at how we can get all of us into one facility here in Racine and support each other as one team, one facility. So we're actively looking at that, how we can be more cost effective here in the corporate and Racine-based operation. Other than that, I'm going to open it up to questions now. Eduardo, could you open the line up? And Jeff and I are happy to take questions.
Thank you. If you'd like to ask a question, please signal by pressing star 1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, that is star 1 on your telephone keypad to ask a question. We'll pause for just a moment to allow questions to come through. I'll take a first question from Noah Kaye at Oppenheimer. Please go ahead.
Good morning, and thanks for taking the questions. To start with, one thing that stood out to us is sure I'm reading the press release right, a 26% increase year over year for the fourth quarter for vet. Can you just give us? Can you talk a little bit about how you're able to achieve the growth there? And should we be expecting it to continue to outperform in future quarters? Kind of the market trend.
So no, John. I guess just to provide color, I would say the fourth quarter last year was a little bit worse than expected, and this quarter is a little bit better than expected. So if I had to just give you my thumb in the wind, I would say it's more like true performance 10%. But again, the vet team and that product and the markets that they serve have done a much better job holding up year over year in the crisis. So can we expect continued growth in favorable comparisons? I think if there's one area in our business right now, that's the area that can perform the best with all the headwinds facing it.
Is that share gains or is that end market? Can you talk a little bit about their position? And I think you commented as well on some of the sales synergy starting to translate. So I just want to tease that out a little bit more.
I'd say it's a mix of share gain and the market and that market growing. So it's got actually, I would say, two tailwinds. We have a great product, a great team, and they're now part of a global twin disc team, which helps open doors and ease people's mind on having global service for that product. But we also see more vessels being built with that technology. So, where other markets are facing headwinds, they're certainly facing the COVID-19 headwinds, but they have tailwinds that are also helping them.
Yeah. On oil and gas, it basically seems like the producers are saying with CapEx, they're done for the year, right? So basically there's gonna be on the OE side, continued headwinds in your first fiscal half of 21. How's the aftermarket holding up? What's activity like, and what are sort of share dynamics like there?
It's slower. So aftermarket, I would say, is slower than I would have expected, given the number of, I would say anecdotally, to talking to customers, the rate at which our rigs are working. So I would have expected a little bit more aftermarket activity. And I guess, what's happening right now is if something is, again, this is not a new playbook. If a rig needs maintenance and it's a certain dollar amount, they'll park it and use another rig. So we have to get through that a little bit. And again, fleet horsepower is reducing. People are scrapping fleet. So I think right now we're just battling, let's use an idle rig versus doing the maintenance. We are getting some, but given the activity that we know about, and then it's our rigs being used, I would have expected more aftermarket right now than we're actually getting. So I think there is future demand coming. It's hard for me to predict when that's going to be, but we're not banking on it for the next 6 months.
Right. So as you think about, and this is in relation to the commentary around, prospects for compliance with the covenants, you are expecting some gradual recovery over the course of the fiscal year. If you had to put your finger on it, where would that really manifest?
I would wait till calendar 21.
In terms of the end markets improving,
Yeah, so I'm end markets improving. I'm not expecting end markets to improve until calendar 21.
Okay, that's helpful. And maybe just a last one. You mentioned a number of cost actions. It sounds like there's a contemplation of potential just real estate footprint consolidation in Racine. Just tentatively, I don't know how far you are with planning, but if you were to do that, what would kind of be the implied savings?
We would shoot for 7-figure savings in operating expense. And it's really, we are at the point now with work from home and the number of people in the office every day, and we don't see that, changing dramatically in the next 6 months. And then it's, if it's not changing because it can't, then we can decide how we want to operate and have a different style of office. We're versus dedicated office to kind of the hotel model. If we can get into one facility, I think we should absolutely look at that. That is something that we should seriously consider, and we've started the analysis and the planning of how would we fit everyone that's in the corporate office into our Twinco or North American operations facility. So it would be a shoehorn right now, but it's absolutely worth looking at because, this facility that used to house 40, 50, 60 people every day is now under 8. So it's the right thing, it's the right analysis to do.
Okay. All right. Thanks very much for taking the question.
Thanks, Noah.
Once again, that is star one if you'd like to ask a question. We'll now take the next question from Josh Chan at Baird. Please go ahead.
Hi, good morning, John, Jeff.
Hey, Josh.
Hi, good morning. Just if I can dovetail off of the cost savings question. So of the $7.2 million annualized, I guess, how much of that did you realize this year? And then I guess how much does it leave for next year? And then also, do you think that those savings are more temporary in nature, just in response to the demand, or are they kind of like structural costs that are permanently taken out of it?
Yeah, I can jump, John. You can comment, but I think based on the actions and the timing, we could get 80% of that within this fiscal year. I would say that it is a reaction to the market and the incoming order rate. And, as markets recover, I think we would adjust our cost structure. It is impacting everybody in Racine in one way or another, and it's not what we would consider a permanent situation. It's a temporary reaction to the current market environment.
Okay, yeah, that definitely makes sense. And then, John, you talked about the average daily order rates kind of improving a little bit. Is it kind of a broad base? You're seeing it across many different markets, or are there specific spots that you're seeing that are coming back a little bit faster?
I would say that and Jeff, jump in because I know you've got the chart in front of you. I would say, Josh, it's aftermarket, marine, and industrial. Typically, and aftermarket, across like oil and gas, ARF, everything. But our new unit order and transmission, whether it's ARF, military, or oil and gas, comes in buckets, huge buckets. And so what we're seeing is, marine new unit, industrial new unit, and aftermarket. Those are the daily order rates that have, shown some. And again, we're measuring off we're measuring from in the basement. So we're kind of stepping up the stairs out of the basement. But at least they're going the right direction and they're not getting worse.
Yeah, that makes sense. Definitely a good sign, even though, I'm sure you would hope for a greater improvement.
Yeah. Jeff, correct me if I'm wrong. The bottom was 8. Okay, sorry, go ahead, Jeff.
No, what was your question?
I was just going to add, Josh, the bottom was April. Jeff, you're wrong, and it's improved slightly since April, month over month.
Correct.
Okay.
Yep. Yeah.
Okay. All right. Yeah, I appreciate the color there. And I guess my last question is on the gross margin. I guess in 2020 you had a few kind of items that kind of impacted the gross margin. So I guess you do get the benefit of lapping those items. So how do you think gross margin could shape up in 21 versus 20, as you kind of anniversary the one-timers, but then, the demand is probably softer to start the year at least?
Yeah, that's a good question. Obviously, for us, mix is such an important factor in what our margin looks like. I think with a similar mix, without that $6 million charge in 20, we would have been about 25%. We've had I think, really good cost reduction effort improvement through the year, kind of demonstrated in our fourth quarter year-over-year improvement. So I think, annualized with the same mix, we could do slightly better than 25, even with what might be a little bit softer volume. So I think we will get some good cost savings. So I think we'll be in that range with a similar mix. Obviously, we would certainly enjoy some improvement in our mix and volume coming back in oil and gas in the second half, which would drive us into the higher 20s.
All right. Well, that's encouraging. All right. Yeah. Thanks for your time, guys, and good luck in the next fiscal year.
All right. Thanks, Jeff.
We'll now take our next question from Barry Hayes at Sage Asset Management. Please go ahead.
Thanks so much. Just wanted to make sure I understood the PPP impact in terms of how it affects the P&L, if it does, or if it's just a cash item. That is to say, am I right? This is forgiven, assuming you spend it down against employee expenses and so on. So that's right. Is there a P&L impact? And in terms of the cash impact, you mentioned it ended in July. So how much of it, was in the fiscal fourth quarter versus how much of it might have gone into the first quarter? Thanks so much.
Yeah, Barry, that is a question for Jeff.
Yeah, good question. So to answer the first part, the spending was expense, right? So there was no forgiveness assumed in our fiscal fourth quarter. So no P&L impact as it relates to PPP forgiveness. We spent approximately $6 million of the $8.2 million within the fourth quarter, and the remaining $2.2 in the first fiscal quarter of 21. The way the forgiveness process, at least we anticipate it working, we will apply for forgiveness this quarter, later in August, and then there is a process that is followed by our bank and the SBA to determine the ultimate level of forgiveness. And you're right, there is a formula and there's specific spending you need to have spent the money on, which we focus very much on getting it spent on the right kinds of items. It's one of the reasons we brought back people and returned wages to their normal levels when we received the funds. So I think we can look for more information on that when we do our first quarter follow-up, a better look at where we are in the forgiveness process.
Great. Thanks so much. Appreciate it.
Yep.
All right. There appears to be no further questions as of right now. I'll turn it back to the speakers for any additional or closing remarks. Please go ahead.
All right. Thank you, Eduardo. And thank you, everyone, for joining our conference call today. We truly appreciate your continuing interest in Twin Disc and hope that we've answered all of your questions. If not, please feel free to call Jeff or myself. And we look forward to talking with you after the close of the first quarter. I don't know if the call will be the last day of October or early November, but it'll be after our annual meeting. So, Eduardo, now I'll turn it back to you.
Thank you. And this concludes today's call. Thank you for your participation. You may now disconnect.